Good morning, everyone. Good day, wherever you are. Some of you in the Eastern time zone, some of you are in the Central time zone. My name is Tom Ashley, and I'm CEO of NAFA Florida. And I want to welcome you to the NAFA Florida Financial Advisors Virtual Sales Symposium, 5 days of top industry and motivational speakers to help you become successful every single day. At this time, I'd like to introduce to you to our symposium ambassador, Cheryl Canzanella from Jacksonville. She's the 2019 NAFA Young Agent of the Year. Cheryl, congratulations, and thank you for doing this for us.
Thank you, and thank you, Tom. Thanks for joining us today. Again, my name is Cheryl Canzanella, and I'd like to remind everyone that is participating today that your lines will be muted during the presentation, but we have enabled that chat feature, so please feel free to use it, and we will be monitoring it for any questions that you may have for John Wheeler today, our speaker. So at the conclusion of his presentation, if he has some time, we'll go ahead and share a few questions with him. And if you have any general questions as well, I'll be monitoring and answering those as well. So feel free to chat away and ask any questions you may have. So thanks for spending some time with us today, and thanks for getting engaged. That being said, I'd like to go ahead and introduce our 2020 NAFA Florida President, Joe Challam. CLU, RICP, LUTCF, LACP. So thanks for hosting this event, Joe. Hand it over to you.
Thank you so much, Cheryl, and welcome back, everyone. Day four out of a tremendous 5-day lineup of fabulous speakers. We certainly hope that you have been perceiving great value. I know we've been getting fabulous comments from the presentations by Wendy Weiss and Brian Holtz, and yesterday we had Susan Combs. I don't know about you, but I've got several pages of notes that looking forward to implementing right away. And you know, NAFA and NAFA Florida are really committed to providing value, and this is just an example of what we're doing for professional development. NAFA does so much more, and we'll chat about that in a moment. But before we move talking about the resources that are available from NAFA, I wanted to introduce two of our sponsors who really we're very grateful they were able to participate in this program, because it's really difficult to put on presentations without support. So now I'd like to introduce Robert Rosenthal of the Rosenthal Agency to share a few words.
Good morning, everybody. Thank you again for joining us. I'm sure we're going to have another great show. Please don't forget, if you have difficult cases or easy cases, I'd like an opportunity to help you, see if we can find a home for your clients, maybe save them some money if they didn't get a good offer somewhere else. My philosophy is it's never a decline unless I tell you it's a decline. Let me shop that case to death to see if we can find something for your clients. Please don't forget, you can always check rates out on my website, therosenthalagency.com. You can also go to the Google or Apple Play Store and download our mobile app, where you can quote and submit cases to your carriers right from the palm of your hand. If you have any questions, don't hesitate to reach out to me. My email address is right there. Send me a text message in the chat or to my cell phone, and I'd be happy to help you. Enjoy the show.
Thank you so much, Robert. We really appreciate your support. Now I'd like to introduce Sam McBride of True Choice Financial, Minneapolis.
Hey, happy Thursday to everybody. Sam McBride here from True Choice. Some of you may already know us and our affiliates within the True Choice family. For over 20 years, we've always prided ourselves on being product agnostic for you and your clients within the annuity, life, and long-term care distribution channels. Even though the virus is still present, I think most of us would agree it is time to hit the reset button. However, right now, as you already know, it's challenging more than ever to meet clients. If you are looking for other ways to distinguish yourself and marketing efforts in the virtual environment we are currently in, I'd love to just have a conversation with you and pick your brain. That being said, we're excited for day 4 of the week-long symposium, and on behalf of all of us at True Choice, thank you for having us.
Thank you so much, Sam. We really appreciate your support. I encourage everyone to visit with Robert Rosenthal and Sam McBride and Todd Carlson of True Choice Financial. They have resources that can really build your practice. I'd like to share a couple of comments or thoughts about what NAIFA does and what NAIFA is and what our purpose is. NAIFA is really just primarily a vehicle to be able to present a common voice to our state and national legislators and regulators about important issues that impact financial services profession and our clients. NAIFA Florida helps educate, advocate, and distinguish insurance agents and financial advisor members. We really appreciate all of the members that have joined us today and invite non-members to learn more about our many resources, including the online education opportunities by visiting www.naifa-florida.org or reaching out to myself or our state office. Like to also share with you that later on this afternoon, our IFAPAC, our Political Action Committee, is having a really fun event. We're calling it Tips and Sips. The primary role of IFAPAC is advocacy. And the role of NAIFA Florida Political Committee is to raise money to be distributed to selected legislative candidates so that we have greater access to share important issues impacting our profession and the clients we serve. If you haven't already registered, please visit www.naifa-florida.org and register for the Tips and Sips event today at 4 p.m. So right after this call is over, please feel free to register. It's really going to be a fun event. Our own Brian Holtz, Tim Meenan, and Craig Duncan will be attempting to do two things at once, sharing their adult beverages at the same time as illustrating unique ways to stay connected with clients and legislators in a post-COVID world. We'll then be auctioning off their personally selected handcrafted beverage packages to the highest bidder. So bring your checkbook and get ready for some fun. Special thanks to Prudential Annuities for making this evening even more special by providing the NAIFA Florida glass tumblers to the first 100 members who register. Again, only members may register at naifa-florida.org. If you're not a member, don't worry. You can become a member by visiting naifa-florida.org and just simply hit the join button. Finally, I would like to share a message about the NAIFA Florida Education Foundation. The Education Foundation was reestablished in 2015 to educate the public and NAIFA Florida members and those wishing to pursue a career in financial services. The foundation offers the following initiatives: scholarships for NAIFA Florida members to pursue the Leadership in Life Institute and Life Underwriter Training Council Fellow programs. Scholarships for those interested in pursuing a career insurance and financial services has just recently been added in 2019. And our first college scholarship recipient was Catherine Ayala, pictured in the photo. And we look forward to honoring our 2020 NFEF college recipient in the near future. Visit www.nfef.org to donate, volunteer, or apply for scholarships. And at this time, I would like to turn the mic back over to our NAIFA Florida CEO, Tom Ashley, who will introduce our speaker for today's program.
Thank you, Joe. I appreciate that. Before I do that, I'd like to welcome a NAIFA trustee who's joined us, Steve Saladino, our own Steve Saladino. So, Steve, nice to have you on today's session. Today's speaker, John Wheeler, is a CFP, CLU, CRPC, LUTCF, CLTC, LACP. As agency executive senior partner of MassMutual Texas Gulf Coast, located in Houston, John is a registered principal and financial advisor with MML Investment Services. John has an extensive background in the financial services industry dating back to 1969. He is a past president of NAIFA Illinois, and he's a current NAIFA trustee. So we have two NAIFA trustees on the call today, of course. He's past chairman of the Member Benefits Committee, co-chair of the Political Involvement Committee. This is all at the national level now. and he's an active member and an ambassador for the Association for Advanced Life Underwriting. He's also a board member of the Forum 400. A well-known speaker in the financial services industry and various bar associations, he has been quoted in such publications as Money Magazine, Life Insurance Selling, National Underwriter, and the Journal of Financial Planning. Ladies and gentlemen, would you please welcome John Wheeler.
Thank you, Tom. Get the presentation up here. It's very much a pleasure to be with you today. Not really the circumstances that any of us had thought we were going to be, but by the same token, we just have to turn our lemons into lemonade at the end of the day. I think more and more today, at least the people that I talk to, are wondering about their retirement. Is my retirement really secure? What's going on with the market? It's up one day and down the next. When I'm talking about risk tolerance to people, I say, the way I explain risk tolerance is it's a lot like eating tacos and getting on a roller coaster. Not everybody has the same experience and find out they don't have the stomach for the ride. So what we're going to talk about is how can I make that a little easier and apply some volatility buffer scenarios along the way. We start out with a quote here from Mark Twain, and the fact that it ain't what you don't know that gets you into trouble, it's what you know for sure that just ain't so. And many people up until the COVID situation thought, well, hey, I have got things all figured out. And now all of a sudden there are a lot more questions. So what many people think they know versus really what's so is most people say, well, the market always outperforms fixed investments in the long run. It's always better to get a tax deduction today and pay tax later. The higher the return, the better, and the more I have to spend. There's never been a 10-year period the market lost money. Said that for many years. The best way to buy life insurance is to buy term and invest the difference. And finally, my health shouldn't be a major problem in my retirement years since I'm relatively healthy now, and after all, I take care of myself. Now, what's really so is the fact that the market doesn't always outperform fixed investment. It goes up and goes down, and the timing of returns is the critical thing. And no one can accurately predict what's going to happen by the end of the day, let alone next year, 10 years from now, or whatever. Tax rates may be higher in the future, and tax deductible today only means taxable tomorrow. We often say, which would you prefer to pay tax on, the seed or the harvest? It's getting into the situation of we really think that long-term tax rates probably are going to be higher in the future because one day we've got to pay for all the money we've been giving away today. Also, the higher the return, the greater the risk. Plus, net return is what you spend. As my father used to say, it's not how much money you make, it's how much you have left that really matters or what you keep. And 08-09 was the first time that we absolutely proved that there had never been a 10-year period the market lost money. Because there in 1 year, we gave away 10 years of gain. Best way to buy term, or the best way to buy life insurance, buying term and investing the difference. We have to also understand that all term insurance is actually priced lapsed before you do. Now, what I mean by that is, at the end of the day, any company's term rates, if you look at the cumulative amount compared to the death benefit of the premiums, at some point in time, usually somewhere between 3 to 7 years before life expectancy, you're going to pay more in premium than you would actually receive in death benefit. So unless you know for sure when you're going to die, that may or may not be true. And when I'm talking to clients, I always say, look, you tell me when you're going to die, I'll tell you the right thing to do. But if you can't commit, I can't either. Health issues are going to become more and more and more of an issue as time goes by. Today, 70% of the people over age 65 are going to need long-term care, and 92% of them for at least 3 years, 4.5% for more than 6 years. And long-term care expense, unless it's properly planned for, can be even more catastrophic than any market return situation we've dealt with today. So a study that was done on which do you fear the most, dying or outliving your money, 39% said dying, while 61% said outliving their money they were more fearful for. Because again, the one thing we want to be sure of is there's not too much month left at the end of the money. We're living longer. We have improved healthcare options. There's more medications and procedures available today. We have better nutrition and healthier lifestyle options overall, and more awareness of health issues. At birth, according to the 2000 mortality tables, a male had a life expectancy of 74 years and a female 79.5. However, if they make it to age 65, now a male had a life expectancy of 85 and 88 for a female. And the longer you live, of course, the longer you live. And it's proven that married couples live longer. I don't know why. Maybe it's just because we want to see who's going to outlast the other, whatever. But those life expectancies increase significantly because if a couple reaches the age of 65, there's more than a 50% chance at least one will live to 92 and 25% beyond 97. My mother actually proved that. When I was born, the doctors told her she wouldn't live to see me grown. We buried her about 4 years ago at age 97. I always just said I hadn't grown up. That's what was keeping her alive. Further projections are the fact of number of citizens over age 85 are going to swell to 11 million by 2035. And the Census Bureau said that 1 in 9 baby boomers will live to see at least age 90. And by 2050, age 65 and over is going to represent roughly 20% of the nation's population. And scientists are now debating, what really constitutes what the average life expectancy is going to be. Some say at least 120, some argue even longer. In fact, in my travels, I found this Time magazine on the shelf, which I just couldn't help but get. And it said this baby could live to be 142 years old. It was all about longevity. And for those of us that have been around for a while, because as in my introduction said with Tom, I started in the industry in 1969 when I was 4. And at that point in time, every contract matured or endowed at age 100. Now contracts don't endow and they don't fully pay out. They may still continue on past 121. Who knows what the future holds? In 2008, there was an estimated 96,000 Americans age 100 and over, which was more than 2 times the 1990 census, and an estimated 601,000 will live past age 100 by 2050, according to the Census Bureau. George Burns said his goal in life was to live to be age 100 because it had been statistically proven few people die after that age. Here's the problem. More than half of Americans are going to retire broke. In fact, 34% said they don't have any retirement savings at all, and only 14%, according to GoBankingRates.com, have over 300,000. It varies by age group. 42% of the millennials currently don't have anything saved for retirement, but the scary part is only 29% of the baby boomers do. And at what point is enough money to last as long as we will? 1 in 4 baby boomers haven't saved a nickel. What does that say about the overall cost of the government care and Medicaid and everything else going forward? So let's talk about market volatility. What we're going to talk about today is what is it? Why does it matter? When does it have the greatest impact? And after all, doesn't diversification eliminate it? And can I just buy bonds to eliminate market risk? And what effects does a change in interest rates have on stocks, bonds, or other fixed investments? See, we have an emotional roller coaster because the issue is the average American client invests based upon emotion and reacting to the market instead of responding to the market. And I go back to my analogy of the roller coaster. As I'm going up toward the bull market and everything's going up every day, all of a sudden my hands are in the air. I think everything's wonderful. And then all of a sudden, depending on how steep the drop is, how sudden it is, and how far it falls, where my stomach is. So the average investor is always buying at the wrong time and certainly selling at the wrong time for the simple fact they're reacting to the market instead of responding. If your favorite department store, let's say, was Nordstrom's, and you got a sale bill that said for the next year and a half, everything is 50% off, would you toss it in the garbage and say, boy, I'm going to wait till this is over? No, that doesn't make any sense. But still yet, if there's a 50% adjustment in the market, everybody is walking around like Chicken Little saying the sky is falling, the sky is falling, and possibly because they don't have an alternative plan to be able to wait it out to where they can truly respond. Because if I could respond, that's a great time to buy instead of sell. So what is market volatility? Market volatility refers to a measure of risk and models that measure risk versus return. So when the stock market goes up one day, then goes down for the next 5, then up again, then down again, that's what we call market volatility. And the volatility of a stock compared to an index, like the S&P 500, is where we add and subtract the standard deviation of a stock to represent the expected range of returns when compared to that index. And standard deviation is nothing more than dispersion of returns around that index that's used. So as an example, one standard deviation represents 68% of the expected return, 2 standard deviations would represent 95, and 3 standard deviations would represent 99% of the expectation. And if the prices of a security fluctuate rapidly in a short period of time, we call it high volatility. If on the other hand, it's slowly in a short period of time, that's considered low volatility. And historically, normal market volatility is about 20% per year. So an example of standard deviation would be like this. Let's say that I have an average return of investments of 5%. And we'll talk more about average return in a moment, but all that is an arithmetic mean. I add up all the numbers, I divide by that number of entries, that gives me an average. So if I had a standard deviation of 10, that means that I've got a 68% probability my returns on this particular investment will fall between losing 5% and making 15. A 95% probability of losing 15 to making 25, and 99% of losing 25 versus making 35. Well, that really is not a lot more than a crapshoot, is it? And why don't we have 100%? Because there's always anomalies that can change things. You know, when Congress is in session, they can take actions that can affect the market instantaneously. And there are unpredictable things, like who predicted COVID? I didn't. The market was sailing along fine. The economy was doing fine. And now all of a sudden, we are now having to, first of all, react and becoming educated on how to respond to how do we deal with it. So why does market volatility matter? Well, the more volatile a stock is, the less likely it is to deliver the expected return and has a greater probability of loss. Again, no one is going to cry about that 35% return, but a lot of people might be unhappy with the 25% loss. When does it have the greatest impact? The magnitude of gains and loss counts more than what the frequency is. Bumps along the road don't give us a queasy stomach. It's the true roller coaster effect that does. So it's possible to have more up years than down years and still lose money on average. If I got on an airplane and the pilot got on the speaker system and said, well, you know what, we've got a 50% chance that we're going to land this plane safely to our destination, I don't think most people would necessarily feel comfortable being on that flight. But in reality, portfolios are scored under stroke play rules like golf. Doesn't matter how many holes you win, only the total score is what matters. So as an example, from a match play score, if we took the period of time from 2000 to 2009, where we had a major roller coaster effect, I had 6 good years and only 4 down years. That sounds like that's a winning season. But under a stroke play score, because of the timing of the returns and the severity of the fluctuations, I actually lost 9% during that decade. According to a JP Morgan Chase flow chart, this shows periods of time where we had up years and down years and what the roller coaster kind of looked like. So we went back to 97, from 97 until 2000, the market was up 106%. Then followed by a 3-year relatively decline of 49%. Then we had another upswing of 101%, followed by the 12-month period in 08-09, a 57% drop. And then all of a sudden, things progressively kept going up, 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 up. And by September 30th of 2018, the market was up 331%. Then the last quarter came along, and that 331% turned into only 271%, because in the month of December alone in 2018, the market declined 19% and ended up the year losing 4.3. Then all of a sudden, we started going back up again. And by December 31st of 2019, we had a cumulative 378% increase. But again, if I got off the market too soon and I said the sky is falling, I didn't keep the radio tuned to Billy Joel, keeping the faith, I didn't get a lot of that upturn. Because in December of 2019, my total annual return was 31.4%. 2020 year to date, as of 7/10, the market was still down a little bit, but had recovered from the majority of the loss. If I look at arithmetic mean, which is what we always see published, okay, the average return of this investment is X. Well, if I look at the arithmetic mean, or the average return from 2000 to 2017 of the S&P 500, I would see it had a 7.03% average return. Nobody got that. The correct way of calculating the return would be the geometric mean, which is a time-weighted return. So the real rate of return during that period of time was actually only 4.68%. Now the challenge is, even to be able to get that, if I invested $10,000 at the beginning of 2000, by the end of the year, it had grown to $9,090. Okay, I'm still playing Billy Joel, keeping the faith. By the end of 2001, it had grown to $8,009. I'm a little more queasy. Then if I stayed in the market through 2002, by this time, my $10,000 had grown to $6,239. Well, the average investor somewhere along in there is going to be jumping out, which means that then they miss that 28% rate of return the following year. So that's where we have to learn to be able to respond instead of react. If I dig deeper into the returns, from 1935, when Ibbotson first started tracking things, through 2017, on a 10-year rolling basis, 49% of those 10-year periods, the market did less than 10%. 51% of the time did greater than 10%. So if I look at Vanguard 500, Vanguard 500 index fund started November 13th of 2000. If I then wanted to look further, the average return as of 6/30 of 20 was 7.37%. But again, the return after taxes on distribution, sale of fund shares, and so on for that same time period, according to Vanguard's website, was 4.67%. Now, how many people would think that I really got an actual return of 4.67%? You wouldn't. The return year to date as of 6/30/2020 was actually negative 3.15. So another way of looking at it is somewhat like playing Russian roulette. All right, a gun's got 6 chambers. Only 3 are loaded. I put the gun to my head, then I ask myself, am I feeling lucky? All right, let's pull one of the bullets out. Now I've only got 2. I spin the chamber. Do I feel more comfortable in pulling the trigger? Or even if I pulled it down to only 1, am I really comfortable if that's the only methodology I've got? Probably not. So wouldn't diversification then eliminate market volatility? Diversification can minimize risk, but it can't eliminate it completely. True diversification means investing in a mix of assets that perform differently in various economic environments. So if stocks fall worldwide, for example, other assets like bonds and cash may help buffer that portfolio until stocks recover. So can I just buy bonds and eliminate market risk? Well, bonds have risk also. Bonds have interest rate risk. If Mr. Powell gets up in the morning and sees his shadow and does something with interest rates, all fixed interest rates are affected. So there's an inverse relationship between interest rates and bond returns. So if interest rate goes up, my bond rate goes down and vice versa. Bond rates also have possible default risk, which is the risk that the seller of the bond won't or can't pay the necessary coupon rate that is stated. Also, there's purchasing power risk. Coupon rate is normally fixed, so as interest rates rise, the dollar doesn't go as far, so it's a form of inflationary risk. And there's also potentially a call provision where the issuer may have the right to buy the bond back early. Because if interest rates went down, and let's say I've got some 4% bonds that are issued outstanding in the marketplace, I can now issue bonds at a 2% rate. I want to try to get those 4% bonds off the street. They may have reinvestment rate risk, which means that an investor may not be able to get a return equal to or greater than what they had previously received as the money's paid out. And there can also be credit risk. The lower the credit rating, the higher the coupon, but also the greater risk. That's sometimes where we refer to high yield bonds, and then we call them junk bonds when the market is not favorable. Bonds can also have liquidity risk. It can be hard to attract buyers in a rising interest rate environment other than selling it much lower. Because if interest rates now are rising and I can now get a 6% coupon and my bond has a 4, to be able to sell my bond, I'm going to have to discount it and sell it at a lower rate. Otherwise, someone would obviously prefer the 6% bond. What effects does a change in interest rate have on stocks, bonds, or other fixed investments? Well, changes in interest rates normally have no immediate effect on stock, but there certainly can be an indirect effect due to a change in the cost of money, consumer behavior, etc. However, when it causes inflation, lower risk investments may become more attractive. And as stated previously, bonds have that inverse relationship to interest rates. So when interest rates go up, the bond price goes down and vice versa. Other fixed investments normally have more of a direct relationship to rises and falls in the prime rate, even though it's not always immediate, like the effect on treasuries or CDs or fixed annuities, things of that nature. So it's a little bit like the tortoise and the hare. It's not all about speed or rate of return. Sometimes slow and steady wins the race. And faster or higher doesn't always mean who wins. Higher return possibility with also meaning higher, greater volatility can end up with significantly less in the long term. And the taxation of returns can make an even greater impact than volatility. So it's not one thing that the consumer and we are dealing with in trying to come up with a perfect retirement structure. See, here's the issue. If I lost 40% in the market, as an example, it doesn't mean that when the market goes back up 40%, I'm even. In fact, it has to go up 67% for me to be even. Because when a market value goes down, I don't only lose the gain that I've achieved at that point, I lose principal as well. So if I lost 40% and I went into a 5% average return type investment, it would take 10 years and 6 months to get my money back. Now, obviously, if I could get a 10% investment, it's going to be a shorter period of time. But again, average returns can be misleading because it's the real return that really matters. If I look at recent market returns from a 20-year period of time of 2098 to 2000, or from 1998 to 2018, January 1st of 98, the S&P was 963. By January of 2018, it was 2673, which meant that showed an average return of 6.81%. But if I invested 963 over a 20-year period and I wanted to end up with 2673, that would take an internal rate of return of 5.24%. I didn't get 6.81 because of the fluctuation in the market. Now, by the same token, if I look at the Dow in the same scenario, my average return was 5.42 during that time. Internal rate of return was 5.83. How can that be? Because as I said, it's the magnitude of the gains and losses that matter more than the frequency. If you look in 2008, what happened with the S&P with a 38% loss, if I just look at that 1 year alone compared to what happened with the Dow, where it was only 33, that explains part of that scenario. So it's not the number of years I had down layers or the number of years I had up years, it's how far down were they and how far up were they. In fact, the three biggest risks that can be more devastating even than volatility is obviously premature death. If I don't have proper life insurance coverage in force, all accumulation plans can be destroyed as far as protection for the survivors. I could have made all the right choices at exactly the right time, and if I no longer have the ability to do that, it all ends right there. Also, medical issues. Without proper medical, disability, long-term care coverage, savings and financial security can be destroyed for the entire family. And then lastly, liability. Being on the wrong side of a lawsuit without proper liability coverage can be catastrophic financially. Remember, there's only 2 times you can be sued: when you do something and when you don't. So without those 3 risks being properly covered, you could have been the best saver in the world, made all the right investment decisions at the right time, done in the most tax efficient way, and you and your family's security can still be destroyed. So what if we talked about a supplemental retirement strategy, or a volatility buffer, if you will? If I use a supplement example, let's say that I had a female business owner, 45 years old. And let's say hypothetically that she plans to retire at age 65. And the assumption is by that point in time, she will have accumulated $2 million in qualified assets as a part of that retirement strategy. She desires $150,000 in annual distributions to supplement her income from other retirement sources. And you don't have to be a quick mathematician to see that that's a much stronger withdrawal rate than what we normally say is sustainable. But here again, this is the way people actually live, isn't it? She assumes that she's going to be in a 33% bracket, so out of $150,000 received from a taxable source, she would net $100,000. And she believes in the long run, the best return is going to be the stock market, even though she's aware there's going to be ups and downs, and she may have to ride out a few bear market years. So if I took the time period of 1973 through to 1987 as shown on the bottom, and she's pulling out $150,000 per year, and you'll see that the average S&P return during this period of time was 11.2%. So over a 15-year period, she starts with $2 million, she pulls out $2.25 million, and she still has $900,000 left. So her financial advisor says, see what a great job I did for you. You've already pulled out $250,000 more than what you started with, and you've got almost half as much left. The question is, depending on the timing of the returns and how bad the returns are in the future, how long that $900,000 lasts. Now, if she had an alternative, let's say that when she was 45, she bought $1 million 15-pay whole life with waiver premium. And the reason the waiver premium would be important is that makes it self-completing in the event that she did happen to be disabled during that 15-year period of time. Let's say that she got a select preferred classification, which is the middle of the road. It's not the very best, but it's a little better than standard. Annual premium is $29,910. She does partial surrenders in the years following negative performance years, other than when she's subject to required distribution. And we know that under current law, that now is age 72. It used to be age 70 and a half. So once she reaches 72, whether she wanted to or needed to, she would have to take her required distribution. Now we could talk about QLACs for a portion of it and so on, but that's beyond the realm of this discussion. So let's just keep it simple. So what is a required distribution based upon? It's based upon the value of 12/31 the previous year. And on January 1st, I know whether December 31st was a market loss or not. And in this situation, where at age 74, she'd have to take a required distribution, we're going to take the difference out of this alternative to make up the spendable portion the same way she would have had. So let's look at the numbers. All right, we see that when she was age 65, all right, the market was down 14.8% on December 31st that year. So the next year, we don't pull anything out of that account. She's not subject to RMDs this year. The next year, it is losing 26.5%. So once again, we don't pull anything out. We allow the market to recover and so on. So now you see, by only being right roughly 3.5 years, because you see at age 74, we did have a required distribution that she had to take. We're going to pull the difference out for her spendable money. Now I end up with $3,353,000 instead of $900,000. I was only right 3.5 years out of 15 as that hedge, but it can make a significant difference. I think that $3.3 million going forward is going to make her feel a whole lot safer about her future than the $900,000 would. So with my 15 pay whole life, remember I put $29,100 in for 15 years, but I'm pulling out $100,000 in the years to replace that. Why? Because I'm pulling out in a way that's income tax free, because I could surrender dividends up to basis and that not be subject to tax, then switch to a loan as long as it's not a modified endowment. So she's still pulling out $349,000 of the money that she had put in during that period of time, but she still also has $843,000 left. And the biggest issue during this period of time that we have to realize is we know we're all going to die someday. With this type of retirement hedge, in the event that she died at age 80, there's also $1,239,000 that comes back in as an income tax-free death benefit to replace part of what she spent while she was alive. So even though I still have a gain in this scenario over what I had put in, I still have the life insurance that does not have an ongoing cost because it was fully paid up after 15 years. So what if I just bought a 15-year term and invested the difference instead? So if I bought a 15-year level term with waiver premium, annual premium of $1,205, I invested the difference in the whole life in the term for the first 15 years, and then I withdraw the term premium from the side fund for the remaining 5 years and continued, and I assumed I got a taxable account rate of return of 5% before taxes every year for that 20-year period. And then I assume, obviously, the term's going to end after 15 years because when she sees what the price is in the 16th year, she likely isn't going to want to pay it unless she's already on her deathbed. Here's what it would look like. Now, we already know that I've got $843,000 left in my whole life. We see the death benefit's gone. It's been gone after 15 years. I'm pulling out the same amount of money. I started out looking better. But then as I start pulling that money out, look what I end up with at age 80. I'm actually better off, and I still have $1,239,000 death benefit as well. So that hedging strategy really didn't cost. See, I have to be able to determine the difference between inexpensive and cheap. Term insurance is cheap for a reason, because 90+% of term policies issued never pay a death benefit. Some of those are converted, but one of the biggest reasons is we get priced out of the business. So you might say, well, hey, 74 through 83 was a long time ago. Things are different now. It wouldn't be the same if it was more recently, So let's take a more favorable period like 95 to 2009. See, the great thing about math and market is you let me choose the time frames and I can almost always prove a point. The question is, history repeats itself, but not always in the same order. So if I invested the same way from 95 through 2009, now you'll see, oh, my bottom line's 3,000,003 even after pulling out that 2.25 million. See, I told you it would be better, but wait a minute. There's a problem. Look at what the average return was during that period. Average return was only 10.4%. Our previous period was 11.2%. Doesn't 11.2 end up giving more than 10.4? Well, logic would tell me that, but here's where, as I said, the timing of the returns makes the biggest difference. See, in my previous scenario, I had 3 years of losses in a row. Here, I had 3 years of losses in a row, but they were 6 years down the road. And I had my big loss at the end after the stew had had a chance to cook. Now, do I know what the timing of returns is going to be? If you do, I'll go to work for you, because I certainly don't. But here's the issue. Let's say we had the same rates of return, but we reversed the order. Uh-oh. Now I've still got the same average of 10.4, but now I'm not even able to pay the $150,000 in the 15th year. Why? Because my biggest loss was early on instead of later on. I didn't have time for the stew to cook, which is why I say that averages can be misleading. So when I look at average returns, especially in the market, that really isn't meaningful in and of itself, other than a comparison of likes. However, whenever I have alternative strategies and I can play Billy Joel keeping the faith, I don't have to worry. So if I had done that same planning strategy with my retirement alternative, what would that look like? Now, in following those loss years, if I wasn't selling at a loss, I still have over $2 million instead of not being able to pay that $150,000. That's a pretty significant swing. So unless you know definitively what the market's going to do in the coming years, doesn't it make some sense to have a hedging strategy? See, if the sequence was in your favor, yeah, you were ahead by 3,000,003 after pulling out that 2.25 million. But if it wasn't in your favor, you couldn't even pay the $150,000 in the 15th year. With the hedge, you still had $2,009,000, plus you still had the $843,000 of cash value for the $448,650 of premiums you paid, for a total of $2,853,000. And in addition, with using the life insurance, there's also that income tax-free death benefit when you die to replace part of what you spent while you were alive. Because we know we're all going to die someday. But knowing that from a security standpoint for my family, I still have that protection in place and I'm not having to write a check for it, makes me sleep a lot better at night. So let's think about it. Was the possibility of relying on that higher return of a net $462,000 over the hedging strategy really worth the risk of being broke? Plus, you still have that $1,239,817 of death benefit after that 15-year period. Doesn't that make a lot more sense? Do you know what the sequence of returns in the future market is going to be? I don't. Can you afford the risk at the time of distribution? Doesn't it make sense to hedge your bet, to have that alternative plan? Also, very often the cost of insurance is not as bad as what taxation would have been, especially with tax-deductible retirement plans. See, again, the three major factors beyond taxation and market risk is, first of all, accessibility. Can I get to my money? And can I do it easily? Flexibility. Do I have choices when I can get my money? And sustainability. Is my money going to last long enough to attain my goal? Are you going to outlive your money? Remember, most people's number one fear is having too much month left at the end of the money. And a Monte Carlo analysis shows about a 90% probability at a 4% withdrawal rate, you're broke at age 92. And recent studies like Vanguard, Fidelity, and so on now state that 2.75 to 3% is more realistic for sustainability purposes. Will Rogers said it this way: I'm more concerned about the return of my money than the return on my money. See, here's the best savings method in the world. It's called the bear trap and tin can method. When you got your first paycheck, if you went home and dug a big hole in the backyard and put a big tin can there and put a bear trap over the top of it, and you were required to put 10 to 15 cents out of every take-home dollar in that tin can. But if you tried to reach in and out, the bear trap would snap your arm. Where would you have more money than anywhere today? That's zero diversification. That's 100% discipline. That's really what the issue is. See, today the bear trap is still just as effective, but we've made a better tin can. It's called whole life. Now I can have my cake and eat it too, because when my gains are credited, they don't go away regardless if interest rates go up or interest rates go down, regardless of what happened to the market. So which would you rather have? The opportunity to be rich or the guarantee you'll never be poor? Isn't it better to be sure there's money there when you really need it? See, if I'm chasing returns without considering the risk, remember, pigs get fat and hogs get slaughtered. Don't be like the dog who saw the reflection in the pool while holding a pork chop in his mouth, and while he tried to grab the other one, dropped the one he had. Remember, properly structured life insurance also works for the living. It's not just for the heirs. If I've got that alternative method that I can draw on when the market's down and allow the market to recover, I'm in the long run going to be probably 300 to 400% more secure in the long run. So life insurance as a supplement is a low correlated asset providing additional diversification. When we talk about a low correlation, that means it doesn't move the same way. So if interest rates go up, it can have a future effect perhaps on my insurance. It had no effect whatsoever on my existing gains to date. By the same token, when a dividend is declared, it's mine. It isn't going to go away like a return would be on a stock, or if interest rates went up, where the bond net asset value went down if I hadn't held it yet to maturity. So that low correlation means I have something that now can also provide opportunity as well. Income can be turned on and off when it's needed or if it's not needed. Again, let's take my returns while they're there and let's relish them. But by the same token, if I had a down year the previous year, instead of being forced to take a loss for my required distributions or even before required distributions because I decided to retire before that for my lifestyle, isn't it nice to have another place that I can allow the market to recover instead? And I can turn it on and turn it off when needed. The ultimate death benefit, again, also provides a replacement of part of what at least was spent during retirement. Nothing else can do that. It's an accessible asset that can be used for other purposes while I'm saving for retirement. That's the way I paid for my son's private schooling and got all my money back. It's the way I pay for my cars. If I go buy a car, I borrow money from my life insurance. It continues to grow at the same rate as if it were still there while I'm paying myself back. And even if I'm paying a higher interest rate to the insurance company than I might to the bank, I have all my money back, whereas all I've got is a 5-year-old car otherwise. With waiver of premium, it's also self-completing in the event of a disability. I don't care what type of relationship you have with your stockbroker or wealth manager, or what type of relationship my clients have with me. If they become disabled and ill or injured and they can't put money into the retirement plan, I'm not going to do it for them. Unless they have some self-completing mechanism, it isn't going to happen. And if I'm just saving, if I'm the ultimate saver and I'm saving and investing on my own, My broker is not going to do that for me. Can I meet the retirement security goal for my spouse if death is premature? Here again, as with life insurance as a part of a supplement, I have a self-completing nature that will complete part of what I set out to achieve as a savings mechanism, that in the event that I don't come home, when I walk out, dollars walk in. So doesn't it make sense to have at least some of your retirement money in money that you can outlive and that you control the distribution? Thank you. Any questions?
We don't necessarily have any questions at this time, but we do have a lot of great comments and a lot of great feedback for you.
Good.
Let's see, I've got, I'll share a couple if you want right now, or we can wait till
Sure,
the
that'd
end.
be great.
Yeah, so Judy says, nice job that you explain everything so even someone without investment experience can understand. Odalis says it's very interesting, and she's looking forward to the slides and so she can fully grasp the number crunching that you're doing. A nice analogy that Brian Holtz gave was if you had one hand in ice and one in fire, on average, you'd be just fine when you were talking about averages. He also says that you're one of the smartest people he knows and that it's great information. And Jeff Chernoff also said that all term insurance is actually actuarially priced to expire before you do. He loved that statement. He says he's totally stealing it.
Plagiarism is the finest form of flattery.
It's called leveraging.
That's right.
But I don't have any other questions in our chat room at this time. Just some really good comments.
Great. Well, hopefully people got something that they can use. Again, you know, the more I find that I can learn, the less I find that I have to use. You know, the great thing about knowledge is knowing most of the time you don't really need it. And if I go to a hardware store to buy a drill bit, I don't really want a drill bit, I want a hole. You can show me how to make that hole some other way besides a drill bit, who cares? If I'm drilling 20,000 holes a day, it might not even be the best solution. But when we're dealing with clients, if I can take it one step further and I find out why they're wanting that hole to begin with. If they're wanting that hole to put a molly in, to be able to put a screw in to hang a picture of their grandmother, to where when they walk in the door, they see their grandmother face and remind them of the values that they learned, that's a lot deeper connection. People make decisions on the basis of emotion. And if we can get emotion involved in the conversation and we find out what people care about, what they are trying to accomplish, what they're concerned about, what are the things that could cause them not to reach their goals and objectives or to jeopardize the things that they think are important. And then ultimately, how do they want to be remembered? Do they want to be remembered as that person who had good intentions, never got around to taking care of business? Or do they want to be remembered as the person who cared enough to be sure that if something went wrong, there was an alternative plan?
Well, I appreciate your time and I appreciate you sharing all of this with us. Like I said, great feedback. I'm going to go ahead and hand it over to Joe to finish us off for the day.
My pleasure.
Thank you so much, Cheryl. And John, what an outstanding presentation. I think you did a really, really great job based on what I heard and based on what we see on the feedback of really painting a picture of why we are considered essential to our financial services community and the public at large. And didn't John do just an outstanding job just breaking down and kind of summarizing what we do every day of the week? You don't need to be an investment guru or a life insurance genius to understand what John said and apply it today to your practice. And thank you so much. And we do look forward to seeing those notes and PowerPoint slides. Just a quick reminder, if you haven't gotten it, the message so far this week, today at 4 o'clock is Tips and Sips, sponsored by NAIFA IFAPAC, NAIFA Florida IFAPAC, to help raise money so that we can continue contributing to candidates and getting our message across to our legislators. That's Tips and Sips today. If you haven't registered already, visit NAFA-Florida.org and take care of that right now. But just remember, you do need to be a member. If you're not, that's okay. When you go to NAFA-Florida.org, just hit that join link and we can take care of that. And let me get this to work again. A couple of other review items. I know I've said this every day this week, but don't worry, just one more day. Save the date for NAFA Performance Plus Purpose Virtual Conference, October 6th through 8th. We've gone virtual with our NAFA conference, so I'm sure that'll be another outstanding conference. And, you know, keep up to date. Keep up to date. It's so important. Things keep changing. Our NAFA National Publication Advisor Today comes out every other month virtually. It's pushed right into your email box. And the NAFA Advisor Today, as well as the NAFA Florida e-Journal, helps you keep up to date with all of the changing ideas and concepts happening in our industry. They also provide valuable motivational and sales ideas. Speaking of ideas, please share your idea with us at idea@nafa-florida.org. We really need to hear new and fresh ideas, just any thoughts that you might have that could help improve NAFA and NAFA Florida. And while we're talking about ideas and development, we have, if you visit NAFA-Florida.org, you will get a listing of our virtual CE classes provided by NAFA Florida and our local chapters. In fact, we have one coming up later this month. You got to visit NAFA-Florida.org and look at our calendar, and you will see and be able to register for that coming CE. And for those of you who are not familiar, Lilly, our Leadership in Life Institute, which is an outstanding program that really helps grow yourself as a person and also further your development in professional lives. That programming is going to be available virtually starting in 21. So stay tuned to NAFA-Florida.org and NAFA.org to learn more about that. Tomorrow, we are going to wrap up this week of our NAFA Florida Virtual Symposium with Dick Cleary, and he's going to focus on networking and prospecting to success. So we look forward to seeing you tomorrow, one more day of outstanding concepts, sales tips, and motivation to help build your practice. So thank you so much for joining us, and spread the word about all the resources that are available at NAFA and NAFA-Florida.org. Thank you. Look forward to seeing you tomorrow.